Hello, and thank you for being here. I'm Ilanit Appelfeld, and I work with tech companies to make sure their most valuable assets, often the ones that don't show up on the financial reports, are protected and properly presented and valued. And that's where CFOs often face a challenge. The numbers you report don't always tell the full story of your company's value. The intangible assets, the data, the know how, and most importantly, the trade secrets are driving your business, but they're invisible on the balance sheet. This creates a critical gap. If these assets are missing from your financial story, you're not just underreporting value, you're losing leverage in funding, in deals, and in growth. And this means that investors, lenders, and even potential buyers are making decisions based on an incomplete picture. And I know that many of you feel that this. I spoke to a few CFOs that told me that they feel, that they're presenting financials and they're answering investor questions, but deep down they know that their company is worth more than what's on the balance sheet. So how do you make sure investors see the full value of what you've built? And this challenge comes with the territory, especially in tech-driven and data-heavy sectors. And here's a real issue. Financial reporting wasn't built for the digital economy. It leaves CFOs with a blind spot because it wasn't designed to account for trade secrets, for know-how, and other key intangible assets. And yet they're driving the business, the competitive advantage, and the future growth. So if you're a CFO or a CEO or a founder preparing for your next funding round or for a major deal or positioning your company for growth, this is for you. By the end, you'll hopefully have a clearer understanding of how to bridge the gap and confidently communicate your company's true value. So let's talk about assets that drive your business forward. Many of these assets, the ones that fuel cash flow and create a competitive edge, don't always show on the balance sheet. But just because they aren't recorded on the balance sheet doesn't mean they aren't real. And it definitely doesn't mean that they don't generate value. A colleague of mine from the UK, who previously was a CFO and investment banker, shared a great analogy about the connection between IP, intangible assets, and cash flow. And I want to use this analogy. Think of an oil company. Its value isn't just in the revenue, it's in its oil fields, refineries, and pipelines. And these assets appear on the balance sheet, making it very clear how they contributed to cash flow. Now, if you apply this to tech, a software company, the value of a software company is it's in proprietary algorithms, customer data, trade secrets. But unlike oil fields and refineries, these assets don't appear on the balance sheet. Yet they're just as essential in making cash flow work. They drive revenue, they shape the business model, they give a competitive advantage, and traditional accounting just doesn't capture them. And the takeaway here is that CFOs need to get familiar with these assets and be able to talk about them in the context of making the cash flow possible, even if they're not officially recorded. And this brings us to a crucial question. If these assets aren't on the balance sheet, do investors even care? And the short answer is yes. In fact, they care a lot, because when investors evaluate a company, they're not just looking at today's revenue. They're looking at how defensible and scalable your business really is. And this is where IP plays a critical role in valuation. Because protecting your IP isn't just a legal thing, it's a financial strategy. And by the way, it's important just as protecting your financials, because it directly impacts long-term growth, competitive advantage, and investor confidence. So when investors see that your core assets, your algorithms, and your data, and if you've identified trade secrets, are well protected, they see a company that's harder to copy. They see a company that's more resilient, and ultimately a company that's more valuable. And one of the mistakes that I see is that too many companies just overlook this completely. And I see CFOs focusing entirely on financial metrics while ignoring the value of their IP. They assume that because something isn't on the balance sheet, it's not something that investors care about. And that's a huge mistake. If a CFO can't clearly communicate these assets, the company risks undervaluation. So, how do you avoid this mistake? How do you ensure investors see the various components of your business that drive value? Well, the first step is shifting how you see IP, not just as a legal safeguard, but as a core financial asset that drives long-term value. That means viewing IP as less of a cost center and more of a value driver, one that directly impacts revenue, market positioning, and investor confidence. Because the reality is, investors don't just fund revenue, they fund defensible revenue, and they want to know if competitors can copy you. They want to know what makes your business sustainable long term, and they want to see the assets that are driving your competitive edge. So if you can't clearly define and communicate these assets, investors won't just question your valuation. They'll question your company's ability to sustain, its competitive edge, which can lead to missed funding opportunities or to weaker deal terms. And that's why companies that treat IP as a strategic asset and not just a legal safeguard position themselves for stronger valuation and better deal terms. So how do you do this? Let's break it down step by step. There are 4 steps. Step 1 is to identify the IP that drives value. So before you can quantify and protect it, you need to know what IP actually drives your competitive edge. Ask yourself, what technology, data, know-how, the data that makes your company unique. What would hurt you the most if competitors copied? What internal processes, models, or customer insights give you an advantage? Too many companies fail at this first step because they assume IP just means patents. And it doesn't. Trade secrets, data, algorithms, methods, these all create real business value, even if they aren't officially recorded. Let me give you an example. Let's say you're running a fintech company that offers AI-driven risk assessment for lenders. You might think that your most valuable asset, your IP, is your algorithm, or maybe even a patent if you filed one. I mean, it makes sense. The AI is doing the heavy lifting. And if you have a patent, that's great. It can help with investor confidence, and it has other advantages that we won't get into now. But here's the thing. Your real competitive edge isn't in the code itself. It's not in the patent. It's in your trade secrets, the things that give you an advantage that can't be known by others or very difficult to be copied by others. So let's look at these things. First, your data models. This is the financial data. If you're in fintech, you've collected over the years a lot of data. You're using this data to train your AI to be more accurate. And if a competitor wanted to build a tool from scratch, and if a competitor copied your algorithm, they still won't have this data. And then let's look at your scoring methodology, the way your system weighs risk factors, how it looks at behavioral insights, how it looks at spending patterns, how it looks at alternative credit scores. It's not just the AI, it's how it's designed to think and the methodology behind it. That's a trade secret. And then you would have banking and lender integrations, the custom API design, the security protocols, the way the system syncs seamlessly with the bank's workflow. All this for sure has a lot of years of know-how that you've invested in that's very, very difficult to replicate. And that's why they should be defined as trade secrets. And let's not forget regulation and regulatory expertise and fraud detection. So as you can see, there are a lot of knowledge that you've accumulated over the years. For example, this operational advantage is very strong because competitors would have to figure out, how to do it the hard way. So over time, for a fintech company, you may have built an intelligence on borrower behavior that makes your predictions accurate. And even if another company builds an identical AI model, then they won't have the years of risk data that makes your platform so powerful. So think about it in this context. That even a competitor copied your AI model, they probably won't have your proprietary database, they won't have your scoring framework, they won't have your compliance expertise, they won't have the lender integrations. And that's why trade secrets are so important, because protecting them is what protects your competitive advantage. Because in fintech, your IP isn't just the algorithm. So I hope that's clear. And this brings us to step 2. So once you've identified your high-value IP, you need to treat it accordingly. Treat it like a financial asset. This means that you need policies to protect the information, including access controls. You need operational safeguards. Only the right people have access with clear protocols. And companies, I see companies documenting financial controls much better than they document their IP assets. And you wouldn't leave your financials unprotected. So why leave your company's most valuable assets exposed? So now that we've covered protecting your IP, let's move to the next critical step of making sure investors recognize its value. So investors don't just want to hear that you have a valuable IP. They need to understand how it impacts cash flow and growth. They don't want to hear that IP has its own, it's in its own silo and it doesn't impact all other things that happen in the business. So here's how you can frame your competitive advantage, and I hope you'll get it by the examples. You could say our proprietary algorithm improves efficiency by 40%, making it very hard for competitors to match. Or you could say, on the revenue impact, our trade secrets reduce costs by 30%, creating a margin advantage. And you can also say that even if a competitor entered the market, they need years to develop a similar technology and get to the data that we have. So the companies that quantify their IP-driven value don't just raise money, they raise it on better terms. And investors aren't just buying into what you do today. They're buying into a moat that sustains future revenue. And this leads us to step 4, which is aligning your IP strategy with your business growth. So you look at your IP strategy and you see, does it support the future revenue model? Are you protecting the right assets as you scale? Are you updating the protection as new risks emerge? And As I said, the biggest mistake is treating IP as a one-time legal checkbox rather than an evolving business assets. So to conclude, these are the steps you need to take to recognize the full potential of your company's IP. Identify, protect, communicate, and update. And these steps don't just protect your company's IP. They ensure your CFO has visibility, the visibility they need to manage risk and articulate value. Without this, your CFO is left navigating blind and unable to fully assess risk or represents the company's true value. And if you think about it, CFOs already manage some of the biggest risks, but one of the most overlooked risks is trade secret leaks, since trade secrets cover a company's most critical competitive advantage, then losing them could mean losing the business itself. And at larger companies, executives allocate investments based on an asset value. Sorry. So how can a CFO ensure that there are resources that are directed towards a company's key strength if they don't understand, what the trade secrets are? And when you report to the board of directors, the CFO is usually overseeing the process, or at least in the picture. And if you're missing a section on trade secrets, then you're missing a crucial part of the company's value story. Sorry, I'm recovering from a flu. But the reverse is also true. If you give a CFO the right tools, they'll recognize these invisible assets, the ones that drive cash flow, growth, and defensibility, and they'll be able to communicate their value effectively. And someone commented on my post yesterday on LinkedIn saying that in game theory, these invisible assets act as asymmetric information, creating a strategic edge in negotiations with investors and competitors. And he mentioned that if trade secrets are quantified properly, they don't just tell your valuation story, they shape it. And they shift the bargaining power in funding rounds and definitely influence valuations beyond revenue and EBITDA. And I couldn't have said it better myself. Thanks, Ronen. Trade secrets, in short, belong in your financial strategy. If you don't make them visible, investors or buyers won't see the full value of your company. And remember that CFOs don't just report numbers, they define how the market perceives a company's worth. And trade secrets need to be part of that story. Thank you for listening.